Welcome to Building Option Trades from Your Charts. I'm your host, Rick Swope. Our goal in this short video is to help you understand how to use stock charts to identify things like price support, resistance, and volatility. Ideally, this session will help you bring together your technical analysis and trading strategies. In each of the 5 different scenarios that we'll cover in this video, we will first look at the technical setup, that is, the chart setup and why we would consider the trade, the description of the strategy, examples of a profit scenario, and then finally examples of a risk scenario. Let's begin with the long call. In this chart, we have a couple things going on. First of all, a little bit further back from where we are right now, we see that we have a double bottom. That's identified by the dashed green line. A double bottom, or a W reversal, oftentimes occurs prior to the beginning of an uptrend. Notice that the 50-day moving average shortly afterward started to trend up. Now, where we are right now is a crossing of the moving averages. The red line, or the 200-day moving average, had been moving down, and now we see that the green line, or the 50-day moving average, is just now crossing above the 200-day moving average. And we have that with a couple of green candles at this time, and the overall indication is that the stock, which had previously been in a downward to somewhat sideways move, appears to be starting a next move up. So our strategy is pretty simple. It's a long call strategy, and what we're going to do here is buy a call option instead of the stock. The goal here is that the call option will act similar to the stock in that as the stock price rises, the value of the call option will go up as well. Call intrinsic value rises as the stock price rises. The risk that we have in this particular trade is limited to the premium paid. We have lower capital at risk. Instead of buying the stock, which would require a higher capital investment, we are going to pay the option premium, and so our risk is limited to the premium paid. Just like the stock purchase, the profit for this particular strategy is an theoretically unlimited profit. So let's say at the point of crossover that we identified in the charts, we decided to buy a $20 strike call with 85 days left for $7.75 per share. That's the premium. Now we do this when the stock is trading at about $26.22, meaning that we have a little more than $6 of intrinsic value here that is part of the $7.75. If the stock were to continue in its uptrend, as we identify in the chart, and let's say the stock goes to $34, at that point, a 20 strike call will have $14 of intrinsic value. So what we paid $7.75 per share for will be worth at least $14. Now, there are a couple of places that we might identify risk in this particular trade. We, of course, expect that the stock will go up. That's why we take this strategy. What happens if the stock price just stays the same? It doesn't go up, but it doesn't go down either. Well, in that instance, the time value will be lost at expiration. Remember, we had about $6, a little more than $6 of intrinsic value, which means that the remainder of that is time value. So if the stock doesn't go up nor goes down, we will lose the time value, but we'll maintain the intrinsic value. Now, if the stock price drops, we will lose both time value as well as any intrinsic value that results from the drop in the stock price. The next technical setup that we're going to look at, we have a stock that's trading at about $209.95. It has been in an uptrend. In fact, it's been in an extended uptrend, as evidenced by the rising green line. That's the 50-day simple moving average. But now what we see here is that for the first time in quite some time, the stock price has dropped below that 50-day moving average. In fact, it dropped pretty decisively with a long red candle and an increase in volume. This comes after the fact that it failed to make successively higher highs. Where that dashed red line is, we see some overhead resistance. So here it looks like an uptrend that is pausing and in fact even looking to break down. A strategy that we can consider in this example would be a long put. This strategy, we're going to buy a put to speculate. This is different than using puts for protection. Here we don't own the stock. We think the stock price is going to fall. So instead of short selling the stock, which gives us theoretically unlimited risk, we're going to buy a put option. A put option's intrinsic value will rise as the stock price falls. Again, as opposed to short selling the stock, with this strategy, our risk is limited to the premium paid. And our profit, our maximum profit, would reach its maximum as the stock price approaches zero. So the farther the stock price falls, the greater our return on the strategy. Now, we might buy a put with a 220 strike price, 85 days remaining until expiration for $16.50 per share. Now, with the stock trading at about 210, of the $16.50, about $10 will be intrinsic value and the remainder will be time value. A profit scenario here is, suppose the stock drops down to one of its target support levels, call it $190. At $190, the 220 strike put will have $30 of intrinsic value, so it'll be trading somewhere greater than $30. But even at $30, that'll be $13.50 of profit. And the farther the price falls, the more intrinsic value we'll get out of this trade. So what would a risk scenario be for a long put trade like this if we bought the 220 strike put? Once again, if the stock price remains the same, doesn't go up or down, then the time value in our premium will be lost at expiration. But if the stock price does rise, at expiration, we will have lost all the time value and any intrinsic value that would be lost due to the rise in stock price. For the next strategy, let's take a look at the first technical scenario that we looked at, but this time we're going to set it up just a little bit differently. Here, again, we have the situation where the stock has been rising slightly after a double bottom. The stock's currently trading at 26.22, and we've got the crossover of the moving averages, so we're fairly bullish at this point, but perhaps a little bit hesitant. For this strategy, we're going to look at a protective put. Now, the purpose of a protective put is to hedge a position that we have. So we either own already or will purchase the stock. So again, we're somewhat bullish on this. We're confident in the moving average crossover, but perhaps just a little bit hesitant. So in this instance, we want to keep the stock, but we're going to buy a put as a hedge against the stock price falling. Our maximum risk for this particular trade is the cost basis of the stock plus the premium paid for the put. Those are the two costs that we have, minus the put strike price, which is the price at which we would be able to sell our stock if we were to have to exercise the put. For this strategy, our profit is theoretically unlimited because since we own the stock, there's really no limit to how high the stock could ultimately go. So let's assume that we didn't own the stock and we just went ahead and purchased it at the point of the crossover. We would buy the stock at $26.22 and then protect ourselves against the stock falling by buying a put option with a $20 strike put. And we're going to use that protection for 50 days, and that'll cost us $1 per share. In a profit scenario, if the stock were to rise, that's really the best case scenario for us. That's what we want to happen. And so let's say that later on the stock is at $34. At $34, we have made money because we bought the stock at $26.22. Remember, though, that we paid $1 for protection. So our profit here is $6.78. This is a good outcome because, yes, we paid a little bit for the protection, so that chipped away a bit at our profit. But that was for the confidence of knowing that we can hold on to the stock and not have to worry about a catastrophic loss. Now, in that same trade, where would our risk be? Our risk would be in a couple of ways. Let's say the stock didn't go up, but instead remained the same. Now, we're not making any money by owning the stock, and what would happen is we would not use our put either, so it would expire worthless. So we've not profited from stock ownership, and we've lost the amount of premium that we paid for the put. Another possibility is the stock price does drop, but the idea here is that we've placed a limit on our loss. So let's say that the stock drops below $20, which is the strike price of our put. We could do a couple of things. The put could be sold for a profit because the value of that put's actually going to go up as the stock price drops, or we could exercise or use the put, which would then allow us to sell our stock for $20, thereby limiting our overall loss. In our next strategy, we're going to be somewhat bullish, not extremely bullish, and I'll explain why. In this technical setup, we have the stock trading at about $117. Now that green line, that green dashed line, presents what we call a roll reversal. Notice on the left side of the line that the line there acted as resistance. But then the stock price broke above that and came down and tested it, and recently inside that highlighted circle there, the same price level acts as support. Resistance broken becomes support. That's a roll reversal. So that leads us to be a little bit bullish here. However, we've got a high just in the middle of that roll reversal line that could very well present some risk for an upward move. It could present a little bit of resistance pressure. So we're bullish, but not extremely bullish. The strategy that we're looking at here is called a bull call spread. This is a defined risk, defined reward, which means we have a limit on both our risk and our reward for the strategy. Simply, what we're going to do is to buy a call with a lower strike while simultaneously selling a call with a higher strike. And it's important to note that both calls will have the same expiration. The higher strike call will obligate us to sell the stock, and so that puts a cap on our profit potential. Our maximum risk is the premium paid for the long call minus the premium that we collect for the short call. We call that the net debit. The profit for this strategy is the size of the spread, that is the difference between the strike prices, less the net debit or the net premium paid. So suppose that we buy the $120 strike call for $11.30, and we sell the $125 strike call for $9, and there's 113 days to expiration. So this would be a $5 spread with a net debit of $2.30. Suppose then in this example that the stock goes to $130. The stock price is trading above both of the calls, the one that we bought and the one that we sold. This would lead us to a maximum profit scenario. And what would happen is we could buy the stock for 120, sell it for 125, and then we would see a return here of $5. But remember, we had a net debit of $2.30. So basically, it cost us $2.30 to make $5. Let's explore a couple risk scenarios now. Let's say the stock price remains the same. And if you recall, the stock was trading at about $117 when we did this. So at $117, both of the calls will be worthless. The 120 call and the 125 are both above the current trade price. And in that instance, both calls expire worthless and we've lost our $2.30. But we could also see a situation where the stock rises a little bit, but still stays below 120. Let's say it goes to 119. So the stock price has gone up, but not enough for us to profit from any part of the spread. Again, both calls expire worthless and we've lost our net debit. Now let's look at one other risk that comes into play here when you're looking at a spread. In a spread such as this, you have a long call and a short call. If you remember, a long call gives you the right to do something, but a short call places you in an obligation to do something. So it's possible that prior to expiration, your short call could be assigned, in which case you have an obligation to sell stock, in this example, at $125. So a couple things would happen. First of all, you'll be required to deliver stock at $125 per share. But remember that you have a long call, which gives you the right to buy stock. So in order to meet delivery, you could either purchase stock in the open market, or you could exercise your long call and then purchase the stock for $120. The last strategy that we're going to look at in this video is an example where you own a stock and it's been going up, but it doesn't appear to necessarily be going down, but perhaps there could be a limit as to its further rise. So in this particular setup, we see a stock trading at just under 101. The green line shows us a rising trend, but the red line shows us some overhead resistance here. This could actually be referred to as an ascending triangle. But for the moment, we think that we're going to get higher lows, but not necessarily higher highs. So we're remaining bullish, but bullish with a little upside cap coming up. The strategy that we may consider here is a covered call. We own the stock and the price is trending, let's call it slightly bullish, perhaps neutral. It's important to note that for this strategy, we don't want the trend to be bearish. A covered call is not designed for bearish scenarios. So we own the stock and we're going to sell a call, typically with a shorter time till expiration at or near the resistance. That's where we want our strike price. Now, our maximum risk here is the cost basis of the stock minus the credit that we receive from the covered call. That premium that we receive from selling the call actually serves to reduce our cost basis and thereby chips away at our overall maximum risk. The profit in a covered call is our strike price plus the premium received minus the cost basis of the stock. So let's take a look at a possible profit scenario with a covered call. So remember, we own the stock and now we're going to sell a 110 strike call for 49 days and we're going to collect 60 cents per share. If you remember, this is when the stock is trading at about 101, so it's about $9 above the current trade price. One way that we could profit from this is the stock essentially remains flat. If it remains flat, basically if it stays below 110, then that call will expire worthless. We are not going to be required to sell stock or deliver stock at $110 when the stock is trading below that. So we still own our stock, we still maintain the ability to get further price appreciation, and we keep the premium that we've collected from the covered call. And of course, as long as the scenario remains the same, that is neutral to slightly bearish, we can then go ahead and do it again. So what would a risk scenario be for the covered call? Again, we've sold the 110 strike call against stock that we own. A risk is if the stock price drops. Now, if it drops below the cost basis of our stock minus the premium collected, then we've broken below break even. And so as the stock falls further and further, because we still own the stock, we're going to incur greater and greater losses. The premium that we collect from the covered call will reduce our cost basis a little bit, but it's really not protection against a rapidly falling or a greatly falling stock price. Now, some traders think that if the stock price rises and the shares get called away, that's a risk. That's actually not a risk. That's just a completion of the strategy. We've still made money. We are selling the stock for $110 that we owned at $101, and we got paid to do it. We got paid the 60 cents per share premium. So be careful, because that's not a risk. That has just placed a limit on our maximum profit. If you're in a covered call position and you suddenly become very bullish, how can you take away that limit on your profit? Well, you sold that call to open. You could buy that call to close. And while that'll cost you some money to close the call, it then leaves you with the availability of getting further price appreciation as the stock price goes up. So what we've seen in this short video is that option trades begin with stock charts. Options are derivatives. They're derived from the underlying stock. So consider bringing together your technical analysis with your trade strategy. I'm Rick Swope. Thanks for joining me.